Holy smokers, everybody. I have some big news for you today in terms of the economy and the housing market. It turns out that the same guy from The Big Short, David Burt, who was played by Brad Pitt in the movie, is shorting the housing market again, as he did back in 2008. Similarly to this time, he sees home mortgages as being overvalued and ignoring risks that should be taken into account in terms of their price. So today I'll look into what he has to say, so stay tuned. Hi everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about overall success in investing, as well as going against crowd thinking mentality, whether it be in the investing world or elsewhere. So if you like these kinds of topics, just consider subscribing. And also a disclaimer that none of this is to be taken as financial advice. I'm not a financial advisor. So to begin with, let's look at the housing market and how it has done since the financial crisis in 2008 to 2008. If one word were to sum up the housing market over the last 10 years, it would be phenomenal. The housing market has been on a tear unlike most other times in history. Median home prices have risen much more quickly than median income has increased. In fact, home prices have increased roughly 5 times the increase in income since 2012. Generally, real estate has been seen as a very stable investment, and this generally holds true. In general, real estate is less prone to bubble-like behavior, and even looking at 2007 and 2008, when housing was in a bubble, real estate was not nearly as volatile as something like the stock market, even though it was real estate that ended up tipping this bubble and popping it. So kind of like the bond market, real estate is generally a much less emotionally driven market. It requires much more committed and well thought out decisions than simply buying or selling stocks on Robinhood or other trading apps where you can just quickly buy and sell, stocks and options. Real estate's a much more committed decision. You just don't see people day trading houses. And over the last 10 years, this has made it very easy to be successful in real estate. You could have bought a house or a rental property virtually anywhere in the United States, and you could have done very well. You could have, just held it for even, less than a year and just refinanced it and made money off of that. And sure, some areas have been better than others, but by and large, it has not taken someone of genius intelligence to do well in real estate recently. So what has this been due to, you might ask? If housing prices are increasing so rapidly at 5 times the rate of income, why would so many people be able to afford houses right now? And the answer to this lies in interest rates. Money has been very cheap to borrow recently. During this last 10, 12 years, it's been at practically 0%. And unlike previous recessions, interest rates have never really recovered and normalized since they were cut back in 2008. Instead, they have stayed artificially low. And every time the Federal Reserve has attempted to get interest rates back to a more stable position, the equity markets, so stocks, bonds, real estate, have all begun correcting. So this really is a confirmation that the markets, as they are right now, cannot handle higher interest rates. The bottom line of all this is that this is not a stable position to be in for equity markets as a whole. The economy is in a very precarious situation, and the Fed knows this. If they raise interest rates, equity prices will fall because they are being artificially supported by low interest rates right now. But if they don't raise interest rates, they will not be able to cut them when another recession happens, like it has right now, or they will need to cut them to negative rates. Now we enter into the situation we are in now with COVID shutting down the economy and forcing businesses to close, oftentimes permanently. As a result of this, the Fed cut interest rates down to 0 back in March of this year, and stocks and real estate have rallied since this decision was made back in late March. In fact, housing prices have rallied remarkably since this decision of the Federal Reserve. And this is both due to mortgages being extremely affordable right now, as well as inventory being low. And due to the law of supply and demand, of low supply and high demand, this has sent the price of residential real estate skyrocketing in the past few months. Now all might appear to be fine and dandy, but it turns out that David Burt, one of the investors who shorted mortgage CDOs back in 2008, is now seeing a similar opportunity in real estate. He sees similar mispricings in real estate mortgages that were present in 2008, though this time in 2020, these mispricings are not due to subprime mortgages, but other risk factors he believes are significant enough to send mortgage defaults higher. And these factors are climate risk to real estate and COVID, obviously. First, let's look into his assessment of the environmental risks to real estate, or the risks from climate change. Burt says he can do the same thing when it comes to climate risk. Burt says that as the risk of floods, fires, and wind increases, the cost of owning a home will go up. Costs from higher insurance rates, higher taxes, and uninsured losses. As the cost goes up, the value of the home goes down, and consequently the mortgage of the home is at a higher risk of default. It is just like during the subprime storm when borrowers who couldn't really afford the homes they were buying were offered loans that were cheap up front but then quickly turned expensive. They then defaulted on these loans and home values crashed, bringing the broader economy down with them. So yeah, he goes on to explain a lot of the calculations he has done to verify this, but this is really no different than the subprime mortgage crisis that we had before. It's just due to different reasons. It's not that these mortgages are being given to unworthy creditors. It's people buying the mortgage. It's because these mortgages are in places where the cost of home ownership is actually a lot higher than these mortgages are taking into account, and this is definitely true. Like in the last several years, we've seen that there's a lot more wildfires, a lot more drought, a lot more just damage from hurricanes happening. So, I think this is a really good assessment from David Burt here, and whether or not this is enough to crash it as much as it did back in 2008, I don't know, but he also goes on to explain the threat from coronavirus and just how these two combined have set up a perfect storm for another shorting opportunity. And furthermore, on top of these environmental risks, David Burt argues that these prices have not been priced into mortgages, and the coronavirus pandemic has added another downward pressure on home prices. And this really has yet to be seen. And this takes a much longer to realize. Basically, up until now, the government's bailout programs have prevented this from taking place. To further quote him, COVID has created a lot of problems fundamentally for the systems that support the housing market and have potentially been contributing to the mispricing of these climate risks and asset values, namely that insurance premiums are too low. About 3 million mortgages are now in government or private sector COVID bailout programs, and there's no guarantee that those borrowers will ever get current on their loans again. So the homes are at risk of foreclosure. This is also a very serious threat, just that essentially government bailout programs, they've prevented people from losing their homes up until now, but Burt is arguing that a lot of these homes, it will be very hard for these homeowners to get current on their mortgage loans again. So he argues that these two aggregated factors, placed on these mortgages, is a very similar situation to how they were back in 2008. And back in 2008, mortgages were not pricing in the immensely risky borrowers who they were being given to. And now a similar mispricing of mortgages is taking place with regards to the coronavirus, as well as increased, environmental risk to properties. And now this is definitely something to consider if you're looking at either buying real estate now or in the near future. If you take this into account, then it would probably be wise to wait on buying real estate right now, just because, Burt is arguing that it's very overpriced right now, so you might want to consider that. But again, none of this is financial advice. But also, if this does happen and if real estate prices fall as a result, and interest rates will likely be very low when that occurs, this could present a very good buying opportunity for someone looking at getting into real estate. Again, none of this is to be taken as financial advice, but I like to talk about recent developments with the economy, as well as the people who seem to be credible based on the past decisions that they've made. So anyway, let me know what you guys think about all of this. David Burt, he's kind of a lower figure guy in The Big Short, not as talked about as Michael Burry or Steve Eisman, but yeah, nevertheless, he was one of the people who predicted this last housing crisis, and apparently he sees opportunity right now. So Yeah, let me know what you guys think about this, and I hope to see you again.